This is a debrief of Task 6 from the Audit and Assurance First Sample Assessment. Task 6 is about reviewing and reporting findings and audit opinions. So deciding which audit opinion is appropriate is quite a tricky question. So remember that in our virtual learning environment we have a flowchart which shows what sort of opinion you should give in particular situations. So hopefully when you try this you are using that flowchart. So let's look at part 1 then. There's been a sharp increase in raw material prices. The client has revalued their inventory to current market price values. Now we know that's wrong, don't we? Because IAS 2 says inventory should be valued at the lower of cost and net realizable value. So if the market prices have gone up, that shouldn't affect the cost. So they've overvalued their inventory. The client was asked to reduce their inventory by 77,000 but refused. Materiality has been set at 70,000. So we need to ask ourselves, do the financial statements give a true and fair view? Well, no, they do not, because they've not applied IAS 2 correctly. So that means that the financial statements are misstated. Now, we could still give them a clean opinion as long as that misstatement wasn't material. But in this case, the error is 77,000, materiality is 70,000, so this is a material misstatement. Now we need to think though, is it just material or is it material and pervasive? Well, does this affect every single number in the accounts? No, it doesn't. Is this error so big that it dominates the accounts? Well, no, it's only £7,000 more than materiality. So it is material, but it is not pervasive. And therefore the audit opinion should be a qualified opinion using the except for paragraph. So we would say, except for inventory, the financial statements give a true and fair view, and we would explain what was wrong with inventory. In part 2, the client has significant going concern problems following the collapse of a major customer. The financial statements have been prepared on a going concern basis, but the directors have made full disclosure of their current trading difficulties in the notes to the financial statements. So, do the financial statements give a true and fair view? Well, yes, they do, because there is a going concern problem, but it's been fully disclosed. And assuming that we're happy with the disclosure, then that would be fine. Okay. So, as the financial statements give a true and fair view, then we should give an unmodified opinion. However, there is uncertainty here, isn't there? And if there's uncertainty, we need to decide, is that uncertainty fundamental to the understanding of the financial statements? And because it's going concern, that we would say that was fundamental to understanding and therefore it's pervasive. So while the audit opinion is unmodified, we would modify the audit report because the report would include an emphasis of matter paragraph to highlight the disclosure that the directors have made. Yeah, we want to make sure that the readers of the financial statements have a look at this disclosure about going concern because it's fundamental to understanding their financial statements. So yes, we'd have an unmodified opinion, but the audit report as a whole would have this extra paragraph to emphasize the problem. Then part 3, the client has 3 overseas suppliers who have not replied to any circularization letters. Remember, that's where we're going to write to the customers and ask them to confirm how much they owe us. So you've been unable to gather sufficient and appropriate evidence that trade payables are complete. The balances from the 3 suppliers total 303,000 and material has been set at 280,000. So do the financial statements give a true and fair view? Well, we don't know. Yeah, we've not been able to gather the evidence that we need, so there is uncertainty here. Now, is this evidence related to something that's gone on in the past, or is it something to do with the future? So while it's something to do with the past, isn't it? We've got these supplier balances and we don't know whether they're okay or not. So that means that we've been unable to gather sufficient appropriate audit evidence. Is it material? Well, it tells us the balance is 303,000 and materiality is lower, so yes, it is material. Is it pervasive? Well, this doesn't affect every single number in the accounts, does it? So it's not pervasive because of that. The number isn't so big that it dominates the financial statements, so it's not pervasive because of that either, is it? So it's material but not pervasive, and therefore we'd have a qualified except for opinion. So we'd say except for payables, which may be wrong, but we don't know, do we? Then the financial statements give a true and fair view. Next then, in part B, we need to identify whether these statements are true or false. So a modified audit report does not necessarily mean that the opinion is modified. Well, that's true, isn't it? Because we were talking about that in part 2 here, that here we have an unmodified opinion, but that would be included in a modified report because of the emphasis of matter paragraph. So yeah, this is true that a modified audit report does not necessarily mean that the opinion is modified. And then when there are material differences between the director's report and the financial statements, it is appropriate to disclose this in the audit report. So we don't audit the director's report. Yeah, that is a separate document. But because shareholders generally read the director's report, if there's any inconsistency between the director's report and the financial statements, then that could cause problems, couldn't it? So the auditor's duty is they need to read the director's report to verify that there is no inconsistency. And if there is, then they would be entitled to disclose this in an other matter paragraph. Not emphasis of matter, it would be an other matter paragraph. So they'd be able to tell the shareholders, yeah, by the way, we've got this information in the financial statements, which we're happy with, but it's not the same as the information in the director's report. Again, we don't audit the director's report, but yeah, we need to let you know there is this inconsistency. Next then, the external audit of Fromhold Limited is almost complete, and you're writing the report to those charged with governance. You've identified 3 deficiencies in internal control procedures. So number 1, you noted several purchase orders which were dated after the date of the invoice. It is a requirement in the client's financial procedures manual that all purchase orders are authorised by a senior member of staff. So remember, the idea of a purchase order is that we want to send the order to the supplier saying, look, we want to buy this stuff, and based on the purchase order, the supplier then supplies us. Yeah? So that purchase order verifies that we wanted those goods in the first place. So when the invoice arrives, we then compare the invoice with the purchase order to verify that, yes, this was an approved purchase. So if the purchase orders are dated after the date of the invoice, it would suggest that perhaps we're buying things that haven't been approved. That's the problem. So the question asks us, for each of the 3 deficiencies, identify 2 impacts that this would have on the company and state 1 recommendation. So as we've discussed, one possible problem is that we're buying things that we don't really need. So goods and services that are not necessarily are purchased. Another possible problem is that we are committing to buy stuff from the supplier, but possibly we can't afford it at the moment. So even though we need it, because cash is a bit low, then perhaps we need to delay the order. So yeah, that's the second impact. The business is committed to pay suppliers when cash levels are low. So what about the recommendation? Well, we need to be careful here that we don't simply repeat the weakness, but in reverse. So we can see then that purchase orders don't exist, that we're ordering things without a purchase order. So you could recommend that all purchases need to be supported by a purchase order. But the trouble is that's what they're supposed to be doing anyway. So you may not get very good marks simply for saying the weakness, but in a slightly different way. Okay, so perhaps we need to be a little bit more constructive in terms of how can they improve this process. So, for example, staff should be reminded of the process for using purchase orders before placing orders. So if you can't think of any ideas for recommendations, just think about training the staff to do their jobs properly in the first place. Similarly, if you're running out of ideas, another standard answer is to ask internal audit to perform spot checks to verify that the process is being followed. So in this case, that purchase orders are approved before the orders are placed with the supplier. Okay, let's have a look at the second issue. The payroll manager has the capacity to authorize their own overtime. So you can see the issue with that, that could be applying for any of us. If we could approve our own pay, then most of us would want to be paid as much as possible, wouldn't we? So yeah, we've got a problem here that the manager may be paid more than they actually work. So it tells us then that your review of the payroll indicates the payroll manager is working a considerable number of hours above those stated in their contract. Okay, now it doesn't necessarily mean that they're not working those hours, but there is just a risk that that's what's happening, simply because they can approve their own overtime. So here's our first impact. The payroll manager may be paid for hours not worked. But let's assume that the payroll manager isn't cheating the system and is genuinely working that number of hours. So another impact of this is that the payroll manager is being overworked, and that may lead to errors in the work that's being done. So a recommendation could be the payroll manager's overtime must be authorised. But you see, that's not a brilliant answer, is it? Because it's simply saying what the problem is, but reversing it into this is what you should be doing rather than this is what's not happening. So we want to make this a bit better, and we could do that by suggesting who does the authorisation. So if we say by the finance director, that would be an improvement to your answer. And then for the third issue, one member of staff has sole responsibility for the payables ledger, and a different member of staff has sole responsibility for the receivables ledger. Both staff members both post cash and invoices to their respective ledger. So we can see that there is a lack of segregation of duties here, and that means that they could perpetrate a fraud. So there's our first implication. Lack of segregation of duties would allow the staff to commit fraud. But another problem will be that if someone's on holiday or ill, so if there's any staff absence, then the person who deals with payables won't be able to help with receivables because they have no experience in that area, do they? So it'd be difficult for people to cover each other when there is any staff absence. So our recommendation would be that they need to rearrange their tasks so that no single person is responsible for a whole process. And then finally, for part D, complete the following statement about reporting deficiencies in internal control. So international standards on auditing require that deficiencies in internal control should be notified to those charged with governance in writing. So let's look at the choices here. So should we tell them about all deficiencies? Well, that's probably a bit over the top, isn't it? There may be some very minor ones that aren't really that much of a problem. Should we tell them about just a sample of deficiencies? So yeah, we found 12 problems and here's 3 of them. That's probably not appropriate either. But yeah, if they are significant, so the auditing standards require that we tell those charged with governance about the really big problems that we've spotted while we did the audit.